Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and US stocks fell on Tuesday as doubts about high running valuations preyed on investors sifting through the latest flurry of quarterly earnings. And it was a brutal day led by the mega caps. You could see a Microsoft, Nvidia, all of infrastructure, very red, down 1 and 3%, Palantir down 8%, Nvidia semis also took it on the chin today. Nvidia was down 3.48%, AVGO outperformed but still red, and then we saw software also in the red, followed by Google and Meta. So all of the mega caps took it on the chin. Tesla, Amazon, everyone except for Apple hanging in there in the green. We did see the broad market participate in some upside. I mean, excluding industrials, right, and excluding like the energy sector, we actually did see green pretty through and through in a lot of these defensive sectors, consumer defenses, real estate, utilities, right, and as well as financials. But financials was a little bit harder, sort of like the banks didn't perform. Some of these high flyer names like Robinhood down 5%, Berkshire was up, MasterCard was up, however, Visa was up. Insurance very positive here today. Healthcare was largely positive, and that was the theme of today. We really saw like these defensive sectors, broad market sectors outperform financials, healthcare, real estate, staples. They were in the green, but it couldn't offset the losses we saw today with tech falling, even gold falling. So we did see a little bit of a liquidation in some of the best performing names, maybe a bit of profit taking, but a very ugly day through and through with the S&P 500 down 1%. And again, the majority of sectors falling. And really, we opened the day in the red and we kind of just stayed here. We traded up a little bit. We traded down into the close here. All in all, just a day that wasn't that great for the market and just getting a bit of froth out of the market. We saw growth stocks really take it on the chin. You'd see large cap growth, mid cap growth, small cap growth were the worst performers, and then small caps as a whole underperformed. We saw value and core in the mid cap and large caps outperform relatively speaking, but still red through and through. And look, there wasn't really much news. I think we're seeing a bit of profit taking, a bit of froth coming out of this market after what was a stellar October and a stellar move from the tariff tantrum lows. And also what I guess spooked investors was that Michael Burry, or the quote big short investor, had a couple of cryptic AI tweets and bubble warnings with bearish stock activity on Nvidia and Palantir. He had puts. Now, I do know that the 13F data is backward looking. We don't know if he's in these or still in these or out of these. That being said, I don't think this was great sentiment for the market, especially Michael Burry, the person who called the 2008 housing bubble, coming out and saying, hey, I'm short these stocks. But that could have put a halt on this. That could have been one reason, but I think ultimately we're just seeing a little bit of profit taking at these highs, and I do think the selling is probably going to continue for a good couple of days, maybe through most of this week, until we ultimately find a bottom. Tesla stock was down 3.86% on the back of this. Now, Tesla got sold a lot because Norway's sovereign wealth fund said it would vote against approving Elon Musk's $1 trillion pay package. The market didn't really like that at all. When you look at Hims & Hers Health, it was one of the few stocks that were actually in the green today, barely flat, at one point up about 4% on the back of this news. And that's because Hims & Hers reported third quarter adjusted earnings per share of 6 cents on revenue of 600 million compared to Wall Street's estimates of 10 cents and 580 million. Now, it was actually a double miss here from Hims. However, subscriber offerings climbed 21% to 2.5 million users year over year, and online revenue jumped 50% from a year ago, while wholesale revenue only rose 10%. And when you have bad results and the stock still goes up in this fashion, that ultimately is an opportunity to buy the dip. I think selling probably some cash secure puts here at the $40 mark is probably a great place considering what these earnings were and where the stock is right now. Palantir. Guys, there's nothing to complain about this quarter. Their quarterly earnings for Palantir was just superb. Growth everywhere, raised its revenue outlook, but the company shares still fell because it's trading at like 86 times sales, 600 times trailing earnings. It's just a ridiculous valuation, and we're seeing some of that come out of the stock right now, and I wouldn't be surprised if this continues to go lower. And then having a look at Uber. The ride-sharing delivery giant posted revenue of $13.47 billion, beating the analyst estimate of $13.2. Earnings per share came in at $3.11 versus a consensus of 69 cents. However, the positive results were overshadowed by the company's adjusted EBITDA, which came in at 2.26 billion, missing the expectation of 2.27. While the company showed strong user growth, adding 28 million monthly active platform consumers for a total of 189 million, the slight miss on profitability appeared to disappoint investors who were hoping for a cleaner beat across all metrics, and the stock let go of about 5.77% today, guys. So all in all, we continue to see great earnings, but a bit of froth coming out of this market. And then for everything we saw today, there was 5,100 advances, 4,700 decliners. We saw net outflows here in the New York Stock Exchange. The Nasdaq 100 saw actually mild inflows. The S&P 500 down 1% today. Now, we are still holding, as you can see right here, these longer term averages. So we're still holding the 150-day, we're still holding the 200-day, but we have lost the shorter term and medium term averages, and this is going to cause us volatility in the near term. Now, looking at the market right here, guys, the S&P 500 down 1%, Nasdaq 100 down 1.67%. Very brutal day across the board. We did see some outperformance here in the equal weight mid-caps as well, but ultimately it was just a red day through and through. You can see that the market has just had an unabated rally to the upside, and we're just getting a little bit of froth here out of the market. But again, not crazy. If you look at the weekly chart, we're only down about 0.89% for the week in the S&P 500. Like, it's nothing crazy at all. And we did see a little bit of a signal here with the shooting star doji last week. But yeah, you know, a red day through and through. International stocks were down, US stocks were down, China stocks were down, cryptocurrency got absolutely slammed. I mean, Ethereum is now breaking lower, breaking down below key levels. Bitcoin's still holding the key 100,000 mark, but volatility ticked up in light of all of this. The 2-year and 10-year yields did actually fall, and that is why we did see some rate-sensitive sectors like real estate outperform, relatively speaking. The dollar ticked up, and that's ultimately what you see. When you see gold selling off, assets selling off, crypto selling off, where you're going to go? You're going to go into treasuries, you're going to go into the dollar, right? FX reserves, foreign exchange reserves, and this is why we're seeing the dollar and treasuries TLT up ever so slightly here today. A bit of a safety trade, like a true safety trade would be the bond trade. Gold and silver were also down. Crude was down 0.75%. And looking at the S&P 500, now ultimately we do have like this longer term target where we want to be buyers of the S&P 500 here at the 6130 level. I'm not saying we're actually going to get there, but if we do continue the selling, this is a target that we could look to where we used it as resistance right here, right? Had the tariff tantrum sell off and then broke above to these all-time highs. If we do get here, find some support at these levels, and then find that as a great dip buying opportunity for us to move higher in the S&P 500 into 2026. Do we get there? I don't know. We'll see. Hopping on the daily chart, right? We can see that we are seeing a little bit of buyers come into this market. You can see just by this wick right here, tiny bit of buyers coming in. And if we actually just draw a line right here, you can see that it's the same place where we had resistance right here. We broke above, gapped up, and now we're pulling back. So ultimately, right, if you're a bull, this could be a place where you could look to find a little bit of support and then for the market to continue to move high. If that is the case, this is ultimately where you want to be a buyer. However, let's assume we go ahead and actually break below this level right here. If we then break below, right, and then use it as a resistance, that probably means we do go lower, and then we could probably target the 6,500 area as our next area of probably support, I would say, in that regard. So right now we're at a very critical level. If we break this, right, we're going to go ahead and fill out some of these gaps we have and probably target these lows of 65.50 and then see where we go next. If we do take a measured move, right, you can see that that would be about another 3% from where we are, and it'd be about a 5% pullback from peak to trough. So it's very much possible. I think if we do go ahead and break this level right here, then we can start looking at the 6130 level, but we'll talk about that when we actually get there. Right now, I think the ultimate target is either we buy the dip right here at this level, or we go lower towards the 6,500 area for the S&P 500. Very similar situation for the Nasdaq 100. You can see we're at this very key and critical level. We either, there's a bit more room to run here in the Nasdaq 100, but ultimately the key area of support is sort of right here at this 24,000 area. This is a key level of support. This is where we are right now. There's a little bit of room to run here with the Nasdaq 100. We either find support, continue the move to the upside into the end of the year, or we break below and then we continue to go. That's ultimately what I'm seeing right now, and this is the key line in the sand, the 25 to 50 area, in my opinion. And the next leg of support will be here right at the 24 to 50 area. That's how I'm seeing the market right now. That's probably where you want to go ahead and buy the dip. These are the two cleanest setups I'm seeing right now. And again, even though we are getting the Nasdaq 100 down nearly 2% on the day, it's not crazy. And we had a lot of froth come into the market. We need a bit of this froth to remove. Pullbacks are actually opportunities. There should
they're not days that we need to be scared of. I didn't do anything today. All I did do was sell an open door cash secured put at the $7 mark because the premiums were absolutely jacked. I got like $1 for this. So this is that's the only move I took today. I just sold one open door put. I probably will sell a couple more as the week goes on, but I think we're looking at great support right here. And I do think the real estate sector is still going to continue to outperform, especially as we can see 2-year and 10-year yields falling. So this is one stock. I mean, I'm also in another real estate stock that I do like, PLTR, Better Home and Finance Company. I have $60 cash secured puts right here. There's a huge volume area right at this level, right at the $60 area. I think we're going to find support right here and then continue the move higher. I got this one out to December and it's paying something like $8. Absolutely insane, the premiums on these two names. So those are the two stocks I'm looking at to probably, get into the dip with some cash secured puts. I think a great way to buy this dip is through cash secured puts because you can harvest some premium, you give yourself some downside, and you're happy to take those shares if they do get assigned anyway. Now, looking at cryptocurrency, looking at Bitcoin, yeah, this is not looking good. We've broken the 103 area, and I think if we don't find support right here, I think Bitcoin can probably see closer to the mid 90s. Okay, Bitcoin not looking constructive right now. This is not what you really want to see in Bitcoin, and even on the weekly chart, this is looking very, very ugly. Ethereum looks even worse, breaking below this wedge we've been in, or this zone we've broken below here. And I think if we don't find support right here, the next level is like the 2700 level here. Ugly price action, not exactly what you want to be seeing as a bull. So ultimately, if you're in crypto right now, the only thing you can do is really just hold on. I guess add more if you are a deep believer in Ethereum, etc. Now, Ethereum can move crazily. I mean, if you actually look at the year-to-date chart, right, the stock went from 3,700 to 1,300. That's a 60% move to the downside, right? 60%, absolutely crazy. And then from here, and then on a peak to trough basis, right, from here all the way to the highs, it was up 252%. So these types of big moves are very, very typical for Ethereum. This is not crazy if you've been in crypto for a while, but as an equity investor, this is a pretty big move, down 8%, down 9% yesterday. And just absolutely the volatility of this, you have to be prepared for that volatility, guys. Now, quickly diving into the dollar, you can see the dollar actually gaining here. We've been saying this off these lows for a while now. I said the dollar is looking for some strength, and I do think the dollar is probably going to continue to move higher. And that is going to come with gold weakening. You can see here the GLD trying to find support right here, but retesting these lows here at the 360 area. Let's actually just go to the futures. I do prefer looking at this chart. You can see right here, trying to find support right here. Gold after being down about 10% from its high. So ultimately, this is the line in the sand, the 3,900 area. If we then go ahead and actually break below this level right here in the gold trade, I think we can then probably go target like the 3,700, possibly 3,600 area here for gold. However, if we continue to hold this area, this is actually probably the place where you want to buy. Probably looking for all-time highs and looking to carry yourself in this debasement trade. So yeah, gold definitely a place where you want to be in this market. But should you be in it right now? I don't know. You should be looking for sales. I mean, if you're looking for gold companies, you could look for something like Newmont Corporation. Gold's down about 10%. If we take a peak to trough move, Newmont is actually down about 22%. Actually, look at where it is right now. It's about 19%. So this is probably where you want to lean into a name like this. If you're looking to buy gold, but you don't want the asset, but you want a company, Newmont is a very clean play on gold. And especially with where crude prices are right now at $60 a barrel, it means shipping gold and actually mining the gold is relatively cheap, especially with the gold price still very elevated. I mean, the gold price, like we said before, was trading at what, $39.40. These companies like Newmont are still going to make a ton of money off this trade, given where crude is right now.
Guys, diving into sentiment, we continue to be in the fear zone right here. We are pushing into the neutral camp, as you can see closer, but we still are in the fear zone as markets continue to push higher, guys. And this is probably indicative of the markets we have seen in the last couple of weeks. We're seeing mega caps rally and the broader market breadth is waning, and that is probably why we are still in this fear zone. However, when we look at other aggregate data measures, when you look at S&P 500 overbought and oversold stocks, you can see that 41% of stocks are oversold, only 23% of stocks are overbought. So when you dive under the hood, there is a good reason why we are still in that fear zone, and ultimately this is the reason for us to move higher. And when we look at the earnings, right, it looks like it's only just beginning. I mean, Right now for Q3, the estimate is for 10.7%. The real numbers are closer to about 13, right? But then we should see a step down here in Q4 to about 7.6%. Assuming a beat, we probably do 9%. And then from there, Q1, Q2, Q3, Q4, 2026, we should see a healthy step up closer towards that 15.9% growth mark here in Q4 2026. Absolutely crazy earnings. So if you think earnings are crazy now, it's only going to get crazy, and this is ultimately going to underpin the rally. And when we talk about more Q3 earnings, right now S&P 500 earnings surprises are the highest ever, excluding COVID. Excluding this, it's one of the highest ever. This has been a fundamentally guided bull market with only 1% year-over-year multiple expansion. You guys want to know something crazy? If the S&P 500 PE multiple was to expand by 2% today, the S&P 500 would be at 7,200 plus. So 7,000 markers not out of the water. So bears, count your blessing on each pour, because once the market gets going, we are certainly going higher. Now, there are a couple of things to be worried about. Strippers think we are absolutely, without a doubt, in a recession right now, whether people want to admit it or not. I'm just kidding about this, but there are some concerning signs in the labor market and in the housing market, and one of them is housing inventory. Despite rates, we're not really seeing inventory move lower like we should. When we are easing rates, you tend to see this. When we're raising rates, you tend to see this or this. Housing inventory continues to just sit, right? In other words, two things need to happen. Rates need to go lower or prices need to come down. Maybe somewhere in between, both need to happen, but either or, the housing market is not getting the push that rates would normally give it right now, and that probably is an arbiter of price. When we look at data for the rest of the week, tomorrow we're getting ADP employment change, so this is a really good barometer for what's to come. We're looking for about a 24,000 number right there. I think this number is actually going to outperform, in my opinion. I think we're going to get closer to the 36,000 level. The ISM PMI services, we're looking for a 50 number right there, and that's pretty much it. The mortgage rate to come in at probably at 6.3. In terms of data, tomorrow we get McDonald's, Lemonade, and Unity Software before the open. I think McDonald's and Lemonade are really going to be what's going to drive the market, especially in the small cap space and the fast food space. And after the close, Robinhood, Qualcomm, that's really going to move the market. We do have ARM, IonQ, Duolingo, ELF, Lyft, DoorDash, Joby. A lot of these like mid to small cap names is reporting on Wednesday, and these are like market movers. For example, Qualcomm, Robinhood, these are really going to move the market in their respective industries. Lemonade here in the insurance industry as well, Lyft in the ride sharing industry, but that's because we also had Uber here today, guys. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.